All right. Thank you so much for joining us today for the Lakeview Parallel Market Update. I'm Brian Boughner, and we're going to spend the next 15 to 20 minutes here just talking about the state of the financial markets, things that we're seeing, and things that are positive, things that are negative, and what should we do about it. As we typically start out each call, we look at the S&P 500. And one of the reasons why we look at stocks as kind of a, our first thing that we go to. If you notice, you've been on these calls here for the past couple of months, you notice we're not looking at too much. We look at some economic data, but we don't look at a lot of it because markets that are traded like bonds and stocks and commodities and things like that, they're forward-looking. So they're always trading on forward expectations. Whereas when you get economic numbers, when you get, like unemployment numbers, or you get like GDP and things like that, those are always backward-looking. And usually when the number comes out, they usually revise it a couple months later before you really get that true number of what actually happened in the past. And so what we try to do here is those numbers are important, and we certainly include that in our analysis, but we're also very interested in what trading markets are doing looking forward, and that's one of the reasons why, these next few slides here, you'll see us talking a lot about markets that are trading. So this is the S&P 500 here. Which is the largest 500 companies that trade here in the United States. This is going all the way back to the low of 2009. And, it's exactly what you want to see. You want to see stocks start from the bottom left and go to the top right of whatever you're looking at. We define that as an uptrend, and that's an asset class that we tend to want to have exposure to because it's moving higher and you're making money. So that's a positive. One of the negatives, though, that we see here is we're comparing the S&P 500, again, the largest 500 companies, to the value line index. And the value line is about 13 to 1,500 companies, and they're all equal weighted. So, it doesn't matter if you're, a small company or Apple, you have the same weighting in the index. And what this shows us, it just shows us how many stocks, are really participating in that up move. So if this line is falling, okay, the value line or the equal weighted index is actually outperforming the S&P 500. If this line is rising, then the S&P 500 is outperforming. So what we really want to see is we want to see this line falling. We want to see more stocks participating in that move up. And sure enough, out of the lows, everything was moving higher and everything was doing great. Then we kind of got into some trouble area here in 2011, 2012. We had the Euro debt crisis, and more of your big stocks took over and outperformed because, again, your bigger companies tend to be safer, tend to be a little more well-established. And then, then in 2013, the mother of all quantitative easing programs took place, and we started to see a lot of stocks participate and move higher. And sure enough, the value line started well. As of kind of early summer this year, seeing that change again, and really it's just your biggest, largest stocks that are now outperforming and as the market moves higher. So it's not necessarily a bad thing, but when a market's making new highs, you want to see all stocks participate, just the S&P 500. All right, let's see here. I'm trying to get to the next slide here and having an issue. Let me try this here. Whoops, didn't want to do that. Technical difficulties. There we go. All right. Another thing that we're seeing right now is with the PowerShares buyback portfolio versus the S&P 500. So what we're doing here is we're plotting stocks that have been super actively buying back their shares. And that's one of the things we've seen. Interest rates have been low. Companies are issuing debt. And one of the things they're doing with that cash, they're able to issue low-cost debt, and they're able to take that cash and actually buy back their shares and improve their earnings numbers, right? Because if you made $1 million, okay, and you have 1 million shares outstanding, well, then you made $1 per share. But if you can go out in the market and buy back, 100,000 shares, and now there's only 900,000 shares outstanding, and you make your earnings doesn't have to change, but your earnings per share certainly looks a lot better. And that's what a lot of companies have been doing here these past few years. And as you can see, this red and green line represents the companies that are buying back their shares. The yellow line is the S&P 500. So again, we're going back to the low of 2009. We're starting in the same point, and sure enough, companies that have been aggressively buying back their shares are outperforming, which it makes sense, but this is not a long-term solution, right? You can buy back shares, you can improve some things over the short term, but at the end of the day, you need revenues to grow. You need a lot of healthy things to happen there for to keep moving your stock prices higher. One of the good things that we have going on right now is December is historically, since going back to 1942, is the strongest month of the year, and there are a lot of reasons for this, but right now we have we're expected to have a strong month, and not only that, but January tends to be a strong month as well. So seasonality has actually played out pretty well. We had the dip in October, shot right back. November was a good month, and historically December is a good month, and that's been showing the case there as well. Again, and this just breaks it down a little further for December, and this goes all the way back to 1929. The first half of the month tends to be somewhat flat, and you really get that lift in stocks here the second half of the month. So we will see how that plays out, but if history proves correct, then that's what we're going to see this year. Moving on to interest rates, this has been another positive for stocks. This is the yield curve, so it's showing you what the interest rate was, for the Fed funds rate to 3 months out to all the going all the way 30 years out, and so we call this the yield curve. And as you can see, a year ago, we had what's called a much steeper yield curve, meaning that long-term rates were a lot higher. Of course, if you notice here, short-term rates have been pretty steady, and then over the last year, we've seen longer-term rates come down. So we call this is a flattening of the yield curve, and this is a very positive thing for stocks. Historically, when the yield curve flattens, stocks tend to do well. So that's exactly what we've seen. A negative, on the other hand, for stocks right now when it comes to interest rates is when we're looking at specific spreads. And as you can see here, right now we've got the Merrill Lynch Corporate Master, which is just a kind of a basket of corporate bonds, and then we compare the yield, the average yield on those bonds to a 10-year Treasury. And what we're doing here, so that's the orange line here is the corporate bonds, and then the black line are the Treasuries. And then what we do is we plot the difference between the two. So if you ever hear spreads are narrowing, that means this line's getting lower. Spreads are expanding, this line is getting is moving up. And what we've seen here since this summer is we've seen spreads expanding. And what that helps us measure is where's the investor's appetite for risk. So as that line expands, that means that investors typically don't have that much appetite for risk. If you notice here over the past, since 2011, there's been an increasing appetite for risk as this line has gone down. People have been buying up riskier bonds than Treasuries. Even going a step further than just, corporates, let's look at high yield debt, because high yield is kind of the worst of the worst in the corporate world. And even, again, from 11 to 14, those spreads have been narrowing, so investors have been stepping up and buying risk. Well, if we notice here again, since this summer, those spreads are widening. A lot of investors' appetites for risk is coming down. That is not a good thing for stocks either. We like to see spreads narrowing. We don't want to see spreads expanding with stocks. It doesn't tend to historically always be a good situation. So we're monitoring that. Obviously, stocks, have not, we've not seen any declines or anything like that, but this is kind of a flash warning here that we put on our radar and we continue to monitor. Speaking of just yields in general, though, one of the good things that continues to happen, and this going back to the high in the 10-year Treasury back in recent high in 07, as you notice here, we're still in a downtrend. There's been a lot of talk in the media, interest rates are going higher, they're going higher. We have said the opposite. We think they're going lower or they're going to stay low. And sure enough, we had this rally in 2013, and then it's just been a decline since then, and we think that decline is going to continue. We do not see rates here in the near term moving higher, and we are not afraid of fixed income as a result of that. We think that even though rates are low and you're not going to get necessarily a huge return out of fixed income, it's still an okay place to be right now for the time being. Until we start to see this trend break and we really see interest rates move, we'd like to see we think the 10-year has to really get above 3% for this to break and for us to really start getting concerned that we're going to start to see interest rates move higher. We want to underweight our fixed income holdings, but for now, that is not the case. And sure enough, when you talk about interest rates, you need to talk about inflation. This is a measure of inflation. Again, it's getting back to my original point. We can look at things like CPI. You can look at things that the government produces each month that gives you an interest rate, an inflation indicator. But this, we feel, is one of the best because it takes the 10-year TIPS, which is a 10-year Treasury with an inflation protection put in, and then compares it just to a regular 10-year Treasury. So again, these are buyers and sellers determining these prices, and what we see is inflation, expected inflation less than 2%, which tells us that inflation is not an issue. So sure enough, interest rates are coming down. Holding bonds is not, you don't want to necessarily hold bonds in an inflationary environment. Well, as you can see, we're really not in any type of inflation concerns right now either. And let's talk about a few different markets that are out there. This is a chart of the U.S. dollar compared to a basket of currencies, and we feel that this recent move here in the U.S. dollar is very significant. Of course, this goes all the way back to the early 90s. The dollar had a big rally in the 90s up into the early 2000s, and then just a big sell-off. It's kind of been consolidating here, trading in a range per se, and we feel this breakout is significant. We think over the next few years the dollar moves higher. At this point, that's what the chart shows us. That's what the price movement shows us, and so we're going to make sure that we invest accordingly. And just kind of the opposite of that, what we've seen is oil prices fall, which has been great for the consumer. You go to the gas pump, you're paying a lot less in gas. However, obviously, if you're an oil company, it's negatively impacting you here. Of course, this is the low of 2009. If you remember, oil prices just really came off a cliff back in 08, 09, made a bottom, rallied out of that, and then really just traded range-bound for a few years, kind of $80 on the low end, 110 on the high end, and it was here recently this year getting back up to that 110 number, and then has just fallen off a cliff. We believe that the break below $80 is significant, and frankly, we feel that until oil can get above $80 and show that it can stay above there, that low or lower, either prices at these levels or potentially lower prices could be in the cards here going forward. Gold, we get a lot of questions about gold, and again, gold went on a rally here beginning of this decade. When I say decade, we're in 2014, right around 2000, had a big run up, got up to $1,000 a share, spent some time there, broke through, got all the way up to, say $1,800 a share, and then really has been in a downtrend since then. And we've had a lot of talk here over the past couple, year or so, that gold has been bottoming, and and sure enough, it looked like it had, and now it's made a new low, and it's still in a downtrend. So we just think trying to go out here and buy gold at these levels, you're trying to be a hero. This trend is not broken yet, and we really feel that until you see a trend change here, until you really start to see some money come back into gold, it's an area that we continue to avoid. Similarly, this is a chart of copper, and why do we look at copper? Because copper is the one commodity that's in everything that we use, right? It's in all of our electronics, it's in our homes, it's in our cars, it's anything that's conducting electricity has to use copper. So we look at the prices to see is a lot of demand coming into it, is the price going up, price going down? Because if there's a lot of demand and it's pushing price up, it's kind of telling you that, hey, they're building things, they're making things, and things are happening. And sure enough, out of the lows of 09, you get a lot of demand for copper. Copper almost tripled in price, and then since then, it's just been on a steady decline. And here recently, it's actually made, it's making a multi-year low. So this is not really a positive necessarily when we look at the global economy, that the demand for copper is so weak and pushing copper prices down. All right, and this will be our last slide for today, and we're going to spend a little bit of time talking about this here, because what this does, this just gives us kind of a snapshot of a lot of the markets that are out there, and it just helps us see where is money flowing into, what asset classes are money flowing into, and what asset classes are money flowing in, and why is that important? Because, well, you want to, as an investor, you want to own assets that money is flowing into those assets and pushing those prices higher. Okay, you don't want to be owning a lot of assets that money's flowing out of and pushing prices lower, because then you're losing money. And what we do is we look at all these asset classes and we just break it down kind of year to date, 3-month, and then 1 month. And you tend to want to be in areas where there's a lot of green, and you try to stay out of areas maybe that's a lot of red. And another thing that we also look at too is, so year to date, so this is the return over the last 11 months. And what we try to see is, okay, and I think, like, let's just take consumer discretionary as an example. Consumer discretionary has not been one of the best best sectors to be in year to date. It's actually been one of the worst performers. But if you notice here over the past month, it has been the strongest performer. And these are things that we tend to look a lot at too, whereas, hey, maybe something's been underperforming, but all of a sudden we're starting to see a lot of money flow into this sector. Well, then we bump this up on our radar and take a really hard look at it to see, hey, is this just something temporary? Could something potentially be changing here? So this is kind of this map here, this heat map, what I like to call it, that we look at, helps us determine some of those things. So let's just run through a few things here, and then we'll open it up for questions. A lot of people like to say, hey, stocks are up for the year. Well, no, what's really up for the year? It's the S&P 500. It's large cap, big names, big stocks are what's up for the year. Small caps are only up 2%, 3%. Mid caps are up about 8%. So when you're considering stocks, you really, where you're getting your big returns are from domestic large cap stocks. Because even if we look globally, right? So here's global countries. So we've got Australia, Canada, which are commodity related. We've got Europe in here. We've got Central and South America. We've got Russia, Asia. If you notice, you see a lot of red in here. Matter of fact, the only green that you're really seeing here year to date on a global perspective is really parts of Asia. So when people say, hey, stocks are up for the year, I always say, well, really, it's the S&P 500 and the largest stocks in the U.S. that are up for the year. Everything else is either, somewhat flat or in the negative. So I think that's important to realize, when when people are talking a lot about stocks, you're going to see a lot of articles come out here at the end of the year about, how stocks have performed and things like that. So large caps done well. Here's something interesting we look at too. We've got high beta versus low volatility. So high beta tends to be your a little more of your riskier names. Low volatility tends to be more safe defensive names, and of course year to date, more your safe defensive areas have outperformed. As we get into our sectors, we kind of get the same thing, right? Look at your more defensive sectors like healthcare, utilities, staples. You've got some of your names, even your big tech names are sometimes now considered safe names, like your Microsofts and your Apples of the world. What are the areas that have been doing awful? Well, more your cyclical areas. Actually energy is now negative because of that drop in oil price. Materials is very cyclical. Industrials, consumer discretionary. So even though most everything is up for the year except energy, you've got some very big differences in returns. Commodity prices, we talked about gold, we talked about some of those, price of oil, everything is pretty much down on the year any way you look at it. Currency, again, we were talking about the US dollar earlier. Dollar is the place to be. Just about every other currency is declining compared to the dollar. When we look globally, really, Asia seems to be the strongest place to be globally. Everywhere else has been down. Now, getting back to what I mentioned earlier, something that's a little interesting right now. If you notice, Germany's down for the year. But if you look over the past month, a lot of money's been flowing into Germany and Europe, and I'll show that here a little later as well. Russia, of course, down. Interesting thing about China, they have two class shares. They have the A shares. And then they have, the market that trades in Hong Kong, and look at the price difference between the two. China, the A share part of China has just been doing really strong. India, they had a very big election this last year, and that has pushed that market higher as well. Again, looking at Europe, down for the year, but actually has been up here over the past month. So something that's kind of getting on our radar right now. Is this temporary, or could this be a potential opportunity? Latin America down. Again, most of these other markets are down. Real estate REITs have done well this year, even though MLPs have been negatively affected recently by the price of oil. It's still up for the year. And then another area we're seeing a lot of green too is, again, on fixed income. And this gets back to my earlier point that as interest rates move lower, fixed income is a place that has done well. And as you can see here, whether it's treasuries, corporates, municipals, even though high yields, had a bit of trouble here recently, you're still up for the year, preferred stocks as well. So again, this is just a kind of a market map here that we look at a lot, and just determining, again, what is performing well, what is not performing well. Which brings us to our thesis here. We're emphasizing high-quality, growth-oriented stocks. We don't think interest rates are going to spike anytime soon, so we're good with bonds, low domestic inflation, possible deflationary issues, even in some foreign markets, and that could be another reason why gold continues to not do well either. Investments that thrive with a rising dollar. If you're in the United States and you make all your money exporting, you build and manufacture in the United States and export to the rest of the world, you're probably struggling right now with all the strength in the dollar. So you want to be in areas that tend to just do well with the rising dollar. You look at healthcare, tends to be an area like that where a lot of those things are done here domestically. Utilities, of course, another area there that as well. Defensive sectors over more economically sensitive ones, we talked about that. And then, of course, what we've got going for us right now is the December seasonality strength. So I'll go ahead and stop it there, and we will go ahead and open the call up for questions.